Welcome back to another episode of Investing Explained. Here's today's question. So I absolutely love this question, and I think it's very timely for our episode here with David. Because whenever you hear about portfolio management, everyone always talks about rebalancing. And yes, for most investors, I do think rebalancing is a great idea. For instance, many endowments and hedge funds have portfolios with multiple asset classes, and they don't pick individual stocks, but they look broadly at their exposure to stocks, bonds, commodities, and currencies. For them, I think rebalancing makes a lot of sense, and also for many individual investors who has a large part of their portfolio in the stock market and also own bonds. As they become older, they might want to own more bonds and to preserve wealth, and because they want a low volatility, they continue to rebalance. Now, the idea of rebalancing is to utilize the power of mean reversion and exposure. So, if stocks do really well and bonds do not, you assume this will likely change in the future due to mean reversion, and you make sure to rebalance to have more bonds when they're soon expected to perform better, and you sell some of your stocks before they're expected to perform worse relatively. So yes, on an asset class basis, I think it makes a lot of sense to rebalance. What you specifically address here in your question is slightly different, and you might need a slightly different approach because you're only looking at stocks and you're asking why you should sell your winners and buy more of your losers. And I agree, that is generally not a good approach. The stock market can be very volatile in the short run, but overall, there is a reason why some stocks do better than others. So to answer your question about whether you should rebalance, I would say make sure to conduct an intrinsic value assessment of all your stocks once per year, and be very careful not to be emotionally attached. Make a rule with yourself, and then every 2 or 3 years after you buy a stock, if it hasn't performed well or not as well as you hoped, consider if you're simply wrong in your assessment of that stock and you would need to sell it. You would really need a good reason not to. And for the winners, I would suggest that you should not feel shy by adding more to that position. As painful as it might be to buy a stock at $15 that used to cost $10, consider if there's a good reason why it has jumped 50% and if it's still a good investment. Sometimes it is.
This is really a tough question. I personally look at rebalancing in two different buckets. So the first thing that I would ask myself, am I dealing with an ETF or am I dealing with an individual company? And if we're talking equities. When dealing with an individual company, it's kind of complicated because you're dealing with a current intrinsic value of the company compared to your opportunity cost of owning something else that would give you a higher yield or a higher intrinsic value IRR, as you're looking at all these other companies that you could then take that money after you would sell and then plug it into that other pick. More importantly, it's the opportunity cost of buying the new company with the higher expected yield after you pay the capital gains tax on the existing pick. For example, one of the reasons Warren Buffett continues to hold so many of his non-operational stock picks for decades is because his tax burden to sell the position and then swap the remaining funds into something else with a high level of confidence that the new pick will outperform the previous pick is difficult and kind of risky to project with a high level of confidence. And he's dealing with significant capital gains, and he's also dealing with companies that are often paying enormous dividends compared to the principal that he originally paid to own it. Now, if you're dealing with a company that hasn't really had any gains, then the tax burden is nothing and the decision becomes much easier, and you can kind of look at it just from an apples to apples comparison without that administrative friction in order to transfer into the new pick. You saw this, I can't remember the exact timing, but after the 2009 crash, the 2008-2009 crash, Buffett took a pretty big position in ExxonMobil. And then as the oil prices looked like they were getting ready to drop significantly, Buffett sold his entire position in ExxonMobil. And, a lot of people suggest that once Warren Buffett buys a company, he rarely sells it. Well, if he doesn't have high capital gains, he does sell companies. You also saw this with IBM, where his capital gains on these companies were not very high. His intrinsic value on what he originally had calculated for the business had changed over that period of time. And so he will sell these companies because there's not really any type of tax burden. Now, when you're talking about ETFs, I would argue these decisions may be even more difficult because you're dealing with macro themes driving whether there's opportunity cost or not. For example, if you had some of your portfolio in the S&P 500, it's really difficult to have confidence in how much of your portfolio should have exposure to the overall market versus all the other opportunities that are out there. I think correlation, when you're looking at the correlation of the S&P 500 versus some other ETF or an individual stock pick, really kind of becomes the point where you can maybe adjust your sizing inside of your portfolio. Because if things are correlated, it might make more sense, especially if your intrinsic values are kind of similar. So like if the S&P 500 were to be valued today, I would argue you're around a 3% return to own the S&P 500 is what your expectation should be moving forward. So if you have another stock pick and it's also at 3%, well, you should probably own the S&P 500. So then it comes down to how correlated is just plowing that capital into the S&P 500. How correlated is that S&P 500 to all your other picks that are inside your portfolio? So that's kind of how I think through the sizing and the adjustments, the rebalancing of my investments is I'm constantly looking at what do I think it's worth today versus what do I think my other opportunity costs are, and what do I think that those are going to get me with respect to an IRR, an internal rate of return calculation as a percentage. And I compare those percentages across the risk-free rate versus all the other investments that I have and how correlated they are.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.